Good afternoon, everyone. Good afternoon to everyone in Eastern Canada, and good morning to those of you joining us from out west. It's my sincere pleasure to welcome you all to today's webinar. I might be an unfamiliar face to some of you if you've joined us previously for this series of webinars, so I'd like to take a moment to quickly introduce myself. My name is Sinéad Gleason, and I'm a Senior Product Manager here at Equifax Canada, focused on our commercial solutions. I've been here for 10 years, and I'm very excited to be sharing the insights you'll be seeing here today with all of you. In today's session, we'll be exploring the impact of the pandemic on Canada's small medium business economic landscape, which has seen a combination of local, national, and global disruptions. The challenge for those who manage small medium business credit risk is to understand how to evolve policies and practices to address the global market dynamics in order to effectively support the Canadian SMB recovery. And to that end, we'll have a look at how the Canadian SMB market performed during Q1 of this year, followed by some global perspective. Global perspective, I'm very pleased to have two great guest speakers joining us today. We have on the phone, we have Ian Tobman, Senior Political Risk Analyst with Export Development Canada, joining us from Ottawa. And Ian will be talking to us about the Global Economic Outlook and EDC's Trade Confidence Index. And we also have Cato Severson, the Global CEO of CreditSafe, joining us all the way from Dublin, Ireland. Who will be talking to us today about the growth in international and global trade. Two very distinguished speakers, and I'm really looking forward to their segment of today's webinar as they share their perspective on global economic trends and the impact on Canada's small medium business growth and recovery. But before we get into today's content, I'd like to pass it over to my colleague Sandra Shep, who will walk us through a few housekeeping items regarding the logistics of today's session. Sandra, over to you.
Thanks very much, Sinead, and good afternoon, everyone. Each area within the webinar platform today is responsive, so you can maximize or minimize each widget or box based on your viewing needs. Our presenters are on camera in the media player today, and that will show up in the middle of your screen. Our slide deck will be showing within the slide area, and we'll also have a couple of polling questions to participate in, which will pop up within this slide widget on the left side of your screen, so watch out for that. There's an Ask a Question widget underneath the slide area, so feel free to enter any questions you may have, and we'll address them throughout our session today. In the event there's too many questions to get through, we'll generate an FAQ document, which we'll send out to you in the coming weeks. Today's presentation is available in the related content widget for downloading, again on the left, as well as some other documents you might find pertinent, and French materials will be available within the next few days. Our session today is being recorded, and you will receive the on-demand link via email tomorrow. Bios of our speakers appear on the right, and some new features today you'll notice is a smiley face widget at the bottom of your screen. Feel free to click on how you're feeling about today's presentation during our session. Check it out. We ask that you provide your feedback by taking a short survey, which will automatically pop up at the end of the webinar. You can also access it by clicking on the feedback icon at the bottom of your screen at any time. And to the right of that feedback icon is a Contact Us button. Please send us an email if you'd like any further information, and a team member will be happy to help. Now let's get started. Sinead, back to you.
Thank you, Sandra. So here we all are looking back on the first quarter of 2022, and what a quarter that was. We saw record highs at the gas pumps, in the grocery stores, even used car prices, real estate, and even increased interest rate hikes. It was also the first quarter in what we can hopefully consider the post-pandemic period, as restrictions started to lift, mask mandates are removed, and businesses started opening back up. But just as all as that was happening here at home, so much was also going on around the globe. The pandemic took a toll on the supply chain, and the war in Ukraine started. Let's take a closer look at how things evolved here in Canada over the first quarter of this year. If you turn on the news these days, you cannot escape the stories covering inflation right now. In fact, we are seeing a 30-year high, and it's across all sectors of the economy. Overall, inflation is sitting at 6.8% increase versus April 2021. And when we compare that to the pre-pandemic period, it jumps to 10.1%. And not surprisingly, the highest consumer price index jump is reported on gasoline, which shows an increase of 36% over last year and 34% versus pre-pandemic. But you can really see that climb in prices on the graph on the left when you look at that big dip in prices that happened right when all the lockdowns first started, as to compared to where prices are now. That big valley is where the consumer price index of gasoline was 1 year ago in April 2021. Comparing that to where we are today, and that's a whopping 122% increase. I know personally I'm feeling it when I fuel up. And there's a direct correlation with the orange trend line that you're seeing there, which shows the consumer price index for transportation costs, which has drastically increased as well. But while costs are rising, it's not all terrible news. We are currently seeing a record low unemployment rate of 5.1%, which is the lowest it's been since 1976. Canada added 40,000 new jobs, which was driven by full-time positions as part-time positions were down. And this is great news, considering in Q4 of 2021, there were 900,000 job vacancies, and hourly wages offered were at the highest levels we'd seen. Wages offered increased 5.3% when compared to pre-pandemic levels, as employers needed to attract talent now that businesses were opening back up. But 850,000 small businesses took on federal relief loans during the pandemic. Those relief efforts have wrapped up now, and we are currently in the repayment grace period. Many small businesses have indicated that they have been stretched to their limits in terms of their capacity to take on any further debt. Hardest hit are those smallest companies. And we're seeing here that nearly half of businesses that have less than 20 employees are so heavily leveraged and not in a position to take on any more debt. This is, of course, concerning because these businesses will be focused on debt repayment rather than growth. And with the timelines of CEBA loan repayment on the horizon, it's very likely that negative occurrences will start to come from those smaller businesses. So with all of that in mind at the economic level, let's see what the Equifax Small Business Quarterly Trends are reporting for Q1. When we look across the various factors here, we're seeing that the data is a little bit mixed. It's as though we might be looking at the calm before the storm. New businesses openings are strong, which is great news, and ahead of the seasonal norm that we typically see the spike in the summer months. Year over year, insolvencies are on the rise, but in the latest quarter, we can see it beginning to return to normal behavior. However, the levels are still well below pre-pandemic. So the relief funds appear to be helping businesses pay down their debts, which is keeping the delinquency rates low for now. But as we saw with StatsCan survey data in the previous slide, small businesses have taken on a lot more debt than last year at an average of $36,000. On this slide, we're looking at inquiries activity within the Equifax Commercial Credit Database. And what we're seeing is that the inquiries are starting to recover. You'll see that inquiries start to tick upwards there in the latest quarter, which it's a function of two things. One, credit managers are reviewing their portfolios to get ahead of any issues. And more importantly, two, businesses are seeking new credit as the economy reopens. Provincially, on the right-hand side, the overall increase in inquiries are largely driven by Quebec and Alberta, which is indicative of increased credit demand in those provinces. On this next slide, what you're looking at is the number of new trades opened from financial institutions. So those are credit products such as loans, lines of credit, cards, and even mortgages. we're looking at the data broken down here by the age of business being issued those new credit products. And you'll note that there was an obvious drop during the height of the restrictions. Then if you look towards the last quarter, you'll see a sharp increase, particularly coming from that red line, which are those younger or newer businesses. In terms of credit scores on the right-hand side of your screen, we're really seeing a shift from the norm as credit scores have really improved. This is likely due to those federal relief efforts and even the strength of the businesses that survived during the pandemic. But we should expect that as 2023 draws nearer and relief loans are due for repayment, these trends are expected to shift back to pre-pandemic levels. And in contrast to what we saw with the financial institution trades, here we're looking at the industry trades or those supplier payments, and we don't see the same growth in new trades in the recent quarter. This isn't really surprising, though, as typically suppliers will start off with new trade relationships with sort of a cash-on-delivery arrangement. As those relationships expand and grow, we'll expect to see the new trade lines begin to recover to pre-pandemic levels. But it's clear that the restrictions did have an impact on new trade activity, as there was simply less transacting happening. And like we saw with the financial trades, originations are now coming from those lower risk companies. But again, that's likely to return to the levels we saw pre-COVID. And looking at new business growth in the first quarter of 2022, we see a very positive story. Growth continues to remain strong. We saw that large spike there in Q2 of last year of new businesses as vaccines began to roll out, restrictions started to lift, and optimism was starting to reappear. And that does appear to continue, in fact, actually remaining stronger than pre-pandemic levels. Provincially, we see similar trends with the exception of Quebec, where the higher rate of insolvencies in that province during the past year has resulted in an increase in quarter-over-quarter growth of new businesses. So the good news is that Canada is back in business again. It's certainly a much different environment than it was in 2019, however. So let's take a look at what's happening with delinquencies. As predicted, delinquencies are beginning to plateau this quarter. In fact, when we look at the small business banking trades on the left-hand side of your screen, and those are those financial trades that we discussed earlier, we actually begin to see a slight uptick in the 60 and 90 plus delinquencies versus the fourth quarter. In contrast, however, the industry trades, or those largely on the supplier side, these continue to see some declines, which is good news for suppliers as borrowers appear to be more inclined to pay their suppliers first. And that makes sense when you think about the order of prioritizing debt repayment when businesses need to have good to sells. If a supplier cuts you off, it could critically impact your ability to do business at all. It does, however, signal some caution as we see those financial trade delinquency rates slightly rising. And as I mentioned at the top of this presentation, we might be seeing a sort of a calm before the storm here. So let's take a regional look at these numbers to get a better sense of any hot spots that you might need to be aware of. Looking at the delinquency rates across the provinces, a few things stand out. So once again, we see the contrast in trends between those financial trades on the left and the industry trades on the right. As we saw in the previous slide, financial trade delinquency rates really fell year over year, but it's starting to show signs of stress in the latest quarter. But again, on the supplier side, there is a bit more stability. We see most provinces reporting a quarter-over-quarter decline in delinquency rates, with the exception of the prairies, which is likely due to seasonal variation. And looking at those suppliers' side delinquency rate, you can see where things are sitting across key industries. The retail trade and services sectors have really performed well as the restrictions have been lifted. SMBs are back in business and things are looking positive. Transportation, however, has seen delinquencies increasing both year over year and quarter over quarter. I mean, not surprising given the supply chain issues and fuel costs, but this will be definitely one sector to watch for continued stress. Construction, manufacturing, finance, insurance, and real estate are all showing increased rates of delinquency versus 2021, but things look to be improving in the quarter over quarter view. With the continued stress overseas in Ukraine and ongoing supply chain issues, lenders were going to want to continue to approach with caution. So looking back on the bankruptcy trends, we're seeing here in the latest quarter that the only province that really stands out at this time is Quebec. Quebec businesses posted the highest bankruptcy rates in Canada year over year, but that has slowed in the quarter over quarter view. We're not seeing big increases in bankruptcies coming out of the pandemic yet. Things are nowhere near the levels that they were in 2019. And, you know, that could be a function of the backlogs in the courts starting to clear out, but also those federal relief programs having a continued positive effect. It's interesting to note that there's beginning to be a slight increase when you compare Q1 2022 versus Q1 2021. This will be a trend that lenders will need to keep an eye on as federal aid loan repayments come due in 2023, and those record high trends in fuel, interest rates, and just general cost of goods we discussed earlier will play out over the course of this year. Let's take a closer look at where we're seeing those bankruptcies starting. Unsurprisingly, the story here once again is within the construction and transport sectors. Transportation is really showing signs of an early return to pre-pandemic levels, and construction is on a strong upwards trajectory. And so with all of that, let's recap this quarter's highlights. We saw that the first quarter of 2022 is showing very subtle signs that lenders need to start paying attention to as the year progresses. And small businesses with less than 20 employees have signaled that they're not going to be able to take on more debt. With record high costs and interest rates going up, some of these these businesses might struggle to grow over the coming year. And we also saw that businesses are prioritizing repayment of supplier trades as delinquencies start to creep up on those financial trades. And construction and transportation were the two sectors showing the highest level of bankruptcies and delinquencies. Although there were no real drastic trends as of Q1, it does seem like we're sort of seeing small whispers of caution as we look back on Q1 and wrap up Q2 in real time. And so now I will turn to our guest speakers to get their take on global economic trends and the impact that might have on Canadian businesses. And it is my sincere pleasure to introduce our first speaker, Ian Tobman, on the phone, Acting Manager of the Economic and Political Intelligence Center at Export Development Canada. Ian, over to you to tell us a little bit about yourself and your organization.
Sure. Thanks, Sinead. So good afternoon, everyone, and apologies I'm not on the, get to see my face and some tech issues this afternoon, I guess. Maybe it's the tornado here in Ottawa. So my name is Ian Tobman. I've been with EDC Export Development Canada, and specifically our country risk shop, for about 11 years, covering a variety of regions, currently Middle East, North Africa, but before that, Asia, Africa, and Latin America. In particular, my group is essentially an in-house credit shop, so we're providing country risk ratings for about 200 plus markets, so really quite broad, of various types of risks, including political and economic risks. I think what will be, in case you're not familiar with EDC, with Export Development Canada, is a Crown corporation that provides financing and insurance products to Canadian exporters. Maybe I'll leave it there, and if you want to get into something further. I think there's a lot to chew on today in terms of just talking about the global perspective.
That's great. Thank you, Ian. And next, I'd like to introduce Cato Severson, Global CEO at Credit Safe Group. Thank you so much for joining us today, Cato. Really appreciate it. Can you tell us a little bit about yourself and your organization?
Yeah, I'm very happy to be here. So Credit Safe is a Norwegian company. We're 25 years old. We're operating in 13 countries ourselves. We provide information, on 360 million company globally. And we're like 1,500 staff. And I've been doing some research for this session, and it's very much the same perspective as Canada. Sort of the general feeling is quiet before the storm to a certain degree. I'm really happy to be here. We're the world's most used provider of business reports and the second largest. So we try harder,
That's great.
Okay.
Thank you.
Yep.
All right. So I guess we'll move on to the Q&A discussion segment of today's webinar. And I'd like to ask you both about your thoughts and what you're seeing in your respective fields with respect to the impact of the pandemic on the SMB economic landscape globally. As I touched on earlier, the challenge for those in Canada who manage SMB credit risk is to understand how to evolve policies and practices to address the global market dynamics going forward in order to support Canadian SMB recovery. So maybe what we'll do is we'll start with a polling question for the audience. So before I turn to Ian, I will just, Sandra, if you could put up our first polling question. Great, thank you. So audience, how relevant are global dynamics to the Canadian SMB market in your industry? And we'll see what everyone has to say. Give it a minute to let those results come in. And I think, interesting. I will push the polling results to everyone now. Oh, still some coming in. But it looks like it's about a 50-50 split. It's with very relevant coming out ahead and somewhat relevant. So definitely a topic of interest to our audience here. So question for Ian, perhaps to answer our first question. There has been a lot of growing talk of a global recession led by developed markets. What is EDC's forecast for global growth, and is this concern warranted?
Thanks, Sinead. That's definitely good to know that folks on the call are interested in the global perspective. Because I personally, obviously, I'm biased, but I think there is definitely some tie-ins to the Canadian economy. Canada is a trading nation, and so what happens abroad does affect us, in my view. When we look at the global recession risk, and I would say that our timing is quite interesting with the Fed's latest moves yesterday, 75 basis points. This is clearly a very hot topic, and we just came up with our Q2 forecast. It'll be released next week, so happy to circulate that to folks. But I would say that the global recession risk is pretty much the number one risk for us. The topic you're raising is coming out of COVID, and this is definitely not what we thought we'd be coming back into in terms of this year. Even in Q1, when we did our forecast in January, February, we weren't facing maybe the same extent of risks. But now you look around, China has really been beset by severe COVID lockdowns in the first half of the year, which has severely damaged their domestic economy and therefore global supply chains. Europe is reeling from the impact from the war in Ukraine with higher energy and food prices, of course. And then closer to home, we have higher interest rates, in Canada, but also in the U.S. I want to focus a little bit about the U.S. because it still remains the engine of global growth. the U.S. economy, in particular, the consumer, the consumption plays the largest role in driving U.S. growth and therefore global growth. So while we downgraded our outlook for the U.S. economy a bit, given some of the external risks that I just mentioned, we still think that, walking into this year and walking into this current forecast, consumers are looking reasonably good. Of course, if you were looking to buy a house right now and, higher interest rates are going to impact you, and definitely so. We'll start seeing that very soon if we haven't already. But, coming into this period, households are sitting on a ton of savings. So, I think we're at close to $900 billion above 2019 in terms of demand deposit accounts. Like, they're sitting on a ton of cash. You started earlier talking about the tight labor market in Canada. The same, of course, is true in the U.S. When you look at unemployment rates in May, 3.6%. Again, you talked about average wage rates going up. The same is definitely true in the U.S. So, you have a consumer that has healthy savings, strong labor markets. It doesn't to say that there aren't concerns or there aren't risks to the U.S. economy, and we can talk a bit more about that. But I think the consumer is walking into this period in a much better position than, for example, the global financial crisis. And businesses therefore have to respond to that. Businesses are having to make investments to meet this consumer demand. And you saw throughout COVID, anyone who's on this call who tried to order something, online experienced supply chain disruptions. Companies can only hold off for so long in terms of making investments to add capacity or possibly, even to reshore closer to home in North America. So while I think you'll see, U.S. dollar appreciation will impact U.S. exports, really our story is that it's going to be a risky period, but that we will avoid a global recession, in part because the U.S. economy still has a fairly strong consumer and therefore business reacting to that. So it remains our greatest downside risk in terms of a global recession, and I think you're seeing more and more economists out there worried about that. It is our top worry. It's not a non-negligible probability, but we still think that we're going to avoid a global recession.
Okay, awesome. That's good to hear. And Cato, do you have any thoughts on the global dynamics in impacting Canadian SMB market?
Well, I sort of have to agree with Ian. I'm looking, there's the same thing. There's the decline in bankruptcies sort of generally around Europe, especially. That there are a few countries like Germany and UK and others who's touch and go with the recession. But, the buying power from the employees is definitely there. We're seeing high level of, salary increases as part of the inflation. We got a situation, this month where for the first time in the history, there's more vacancies than there are unemployed people in the US and the UK. So if nothing else, the war for talent is huge out there and it's driving that. So I think the buying power will be there. You will get a dent with just put up the interest rates in the UK again today. We'll do something with the high prices, not with the house prices, but still the buying power will be there. So I'm not too worried. We can't, our models are still pretty predictive when it comes to the scores and these things. I can't see days beyond terms going up. There's a hike in Germany. That's probably one of the most exposed in Europe, with sort of the industry they're in and so close to Ukraine, as you said. But overall, it's just, I've been saying it for a year almost, haven't we? It just feels quiet before the storm, but I'm not too sure anymore. I think they'll sort of ride it off. And the growth in GDP won't be as forecasted a year ago, but it still doesn't feel like we're facing a total crisis.
Okay, awesome.
Yeah.
Yep. How about we do our second polling question? Sandra, if you could pull our second question up. Okay, great. I have to flip over because I can't see the question myself. So second polling question is, which international markets worry you most in the current environment? So that is a question for our audience. If you want to take a second to answer that, which international markets worry you most in the current environment? And we'll see as those results start to come in. I'm thinking that the last option on this question is seems to be the favorable one, and I think we'll push that out to the audience. Now the results of that poll. So all of them are concerning. I guess that's with Europe, of course, kind of behind that. Okay, so why don't we focus, Cato, I'll pose my next question to you. What global trends is CreditSafe keeping a close eye on right now?
But you got a slide for me, don't you?
I do. I can pull that up.
So it was, interesting. We talked about construction and manufacturing earlier being sort of areas being exposed in Canada, and I think these figures are from the World Trade Organization, and to a certain degree, I felt during lockdown that new business was a little bit hard. Nobody really wanted to move, and it was a bit of a standstill. But it's interesting to see that from 2005 to 2019, global trade increased with $9 trillion. But during the last 2 years, it's grown with another 10. So we've seen a huge increase in the use of international reports, and it's very linked to, supply chain, because as the world becomes more of a global arena, we see a lot of usage in search for internationals, and of course, Russian reports for obvious reasons with sanctions and those things. So. That's one I see, a clear trend in usage and something to keep an eye on, because, when we're sitting there in lockdown, trying, buying things online that never arrived, whether it was a new outdoor sofa or whatever, there's an exposure there with container ships in the Suez Canal and other things which, can ruin companies. Yeah, it's an interesting, bit that, the increase in use of international reports was in line with this one during these 2 years, an increase of, close to 30%.
Yeah, that makes a lot of sense. And what about Ian? Do you have any thoughts on, what global trends are really your organization is keeping a really close eye on right now?
Sure. In terms of, we did a recent kind of top 10 risks for the next, let's say, year and a half, and we talked already about the risk of a global recession, particularly in terms of developed markets. But there's other risks out there. Obviously, inflation kind of rising much quicker than expected. We're also watching. We talked a little bit about the war in Ukraine. That remains a pretty sizable risk, and it's having impacts on some other areas, kind of linked risks in terms of global food prices, which have risen significantly, an energy crunch. Cato was talking about Europe. Obviously, as we get closer to the next winter, that's going to become a concern for certain European markets. One issue we haven't really addressed yet is kind of the risk for certain sovereigns. As you see, countries have been borrowing steadily over particularly the last couple of years. As interest rates go up, some of the weaker emerging markets will start to feel a bit of the pain, and so we could see some default scenarios in some of the weaker markets, emerging markets. So anyways, those are some of the topics that we're kind of worried about, we're looking at from our shop.
Okay. And so in terms of, big emerging markets like China, maybe this question is for both of you gentlemen. Are big emerging markets like China, are they facing the same issues like inflation and supply chain constraints? I think you've touched on it a little bit in some of the earlier answers, but if you could kind of explore that a little bit more. Ian, maybe you can start.
Sure. So, I think first we need to recognize that China remains a bit of an outlier when we talk about COVID. They're the only major economy still wrestling with the impacts of COVID. So that in itself makes them a bit different than other big emerging markets. That being said, locking down Beijing and Shanghai earlier this year and other economic hubs is now showing up in the data. So we're seeing, purchase managers indexes for manufacturing services really tank in April. Retail sales for May were down about 7%, the third month in a row. So for really a variety of reasons, we've lowered our GDP forecast for China to about 4% this year and 5% next year. And I would say that even irrespective of these latest COVID policy implications, we have lowered in general our China story and our China outlook. It is closer to the 4 and 5%. China's not going to grow at the 8 and 9% anymore. So on balance, a lot of downside risks there in China. What they have going for them is that there's a pretty sizable or pretty impactful, we'll call it an election in the fall, where President Xi is expected to be confirmed for an unprecedented third term. And so that's going to boost government spending as we get closer to the fall. And so they've already announced, I think, something like 32 or 33 government policies to support consumption, to support the economy. So I think China's a bit of the outlier, but it will drag down global GDP. I mean, it's a major economy. It's a bit brighter on the other large emerging markets. Countries like India remain the fastest growing emerging market out there. They have, they import a lot of their food. They will get hit on the energy cost side. But that being said, there's still a ton of potential on the India side. We're a bit weaker on the Mexico-Brazil side in terms of Latin America. They continue to underperform, I would say, from a GDP perspective. Also for policy reasons and missteps there as well. I think the two issues you identified in terms of inflation and supply chain constraints, they're going to be a bit different for some of the economies that I mentioned. China's inflation is more like 2.5%, whereas it's an issue for Brazil at 12%. It's an issue for India at 8%. So it's a bit of a mixed story. I would say in general, they're all experiencing inflation to different extents, and supply chain constraints are going to affect those countries differently as well. Particularly, China, which had to shut down a variety or different parts of their trucking and port infrastructure. So topics that are affecting us are affecting others, but I would say to different degrees.
Got it.
Yeah, I would agree on that as well, but it's also like verticals in here, like the car industry, is hugely struggling with components for the car. When I bought a new Defender 18 months ago, I was offered 20% more for the car now than when I bought it. This is going to have huge ramifications as well, because it doesn't feel like it's going to end very quickly.
Definitely agree. Yes, definitely agree there. Question, I'm curious, Ian, perhaps you can answer this one. What are the key issues you're hearing from Canadian exporters? Are they feeling, how are they feeling about the economic outlook?
So we just came out with our trade confidence index today, and it's, I think, a really interesting story it tells. I'm just going to pull up a few. Well, I'll share the slides later, but I wanted to raise kind of the top key findings that I think will be really interesting for this group. So just for context, we're talking about a biannual survey that we do with 800 Canadian exporters, and they're across all the different sectors and all the, across the country in different sizes, so SMEs, medium-sized, and large companies. And we've been doing this survey for, over 20 years now, so it's a pretty well-oiled machine. So it looks at expectations for the future, evolving international strategies, and views on emerging markets. So kind of the key findings that I wanted to share with you is that our latest one really plummeted. So the trade confidence index was now sitting well below historical levels. So the optimism that we saw really kind of more in the fall is now fallen. And I'd say that this drop is reflected across all regions of Canada, all business sizes, and all sectors. So definitely something that made us sit up and kind of think. But I think, to me, one of the interesting things is the key finding number 2, which is that orders from the United States and investment intentions remain steady. So despite this growing pessimism or concerns or confidence issues, companies are making decisions with the intention that orders are going to remain steady, and they are making investments with the expectations of getting paid. So that gives me a bit of optimism, and it speaks to, I guess, perhaps a bit of a gap there. Number 3 is that, there are significant headwinds from multiple sources. So typically we get, 1 or 2 issues are big for our customers, but this was across the board. 36% of respondents are being directly impacted by the conflict in Ukraine. Negative impacts of inflation, supply chain issues. There's really a plethora of issues out there, no longer 1 or 2. And as I said earlier, some of them are interconnected, of course, but it does make for a more complex situation. It's no longer just central bankers make one decision and it changes everything. Number 4 is that Canadian businesses are not foreseeing the issues being resolved in the short term. So I think this is important. We think about how long our supply chain pressure is going to last, how long is inflation going to last. At least these 800 polled customers are saying they now expect, almost 70% of them now expect inflationary impacts to last well beyond April of next year. So of course this is going to have implications for their own competitiveness and for their own business planning. And then just quickly last is diversification plans are being scaled back. So obviously for EDC, this is something we look at in particular. And now we're finding that only about 2/3 are planning to export to new countries. And this is down from close to 80% last year. So there is, I mentioned a bit of a optimism around the U.S., if we can call it that, or something more stable. But diversification plans, that is definitely taking a back seat. So there's a ton of, I think, more information from this report that may be relevant for the listeners today. So I'm happy to send that out after.
That would be great. Thank you very much. And we'll make sure that that's available for our listeners. I see that we have 15 minutes left in our series today. And I do see that there are some questions that have come in. So perhaps what I'll do, gentlemen, if you don't mind, is I will read some of these questions and see if either of you want to field them. We have, let's see if I can scroll here. Okay, we've seen subsidies. Oh, that one here. How about this one? So what, in your view, could trigger the next global recession? Does anyone have any thoughts on that one? That's a big question.
I could take a stab at it. And Kato, feel free to jump in as well. I think we started the presentation talking about some of the risks out there. I think from my perspective, while our base case is not a global recession, things are definitely kind of, that risk is growing. And so I think the concern is that really with a significant spike or significant heightened pace, I should say, of Fed action and other central bankers trying to calm inflation, that could create some real tightening in the market. You're already seeing this happen. Of course, the stock market's S&P, and so there is more market volatility, and you could see some snowball there. I mean, the fact that our expectation was not a 75 basis point move yesterday, and so I think that uncertainty of not knowing where the Fed is going and where other central bankers are going, and particularly if they make moves quite rapidly or more rapidly than expected, while the desired intent to ensure a soft landing is definitely there, becomes harder and harder to achieve, I think, without that predictability. So, it's a non-negligible risk for us for sure.
Right.
I just would sort of like to just chuck in if how high will the inflation stay, what will happen to interest rates, and then Ukraine again. Those are the two big risks, the way I see it.
Yeah, I would agree. There's actually a question here for you, Cato. You mentioned businesses are actively watching Russia based on active and pending sanctions. Are there other triggers or alerts that businesses are putting in place around the globe? Any examples that you can share?
Yeah, I mean, this, whether you're regulated or not, there's still, a big consciousness around. I mean, we let several customers go because you want to sort of keep a clear consciousness, don't you? So, yeah, digging around into the compliance space and sanctions, that is, there's a big increase in that, and it's not always that easy, but it's definitely checking from directorships and owners and UBOs. There's a big level of activity there, and companies do have, like some company have zero tolerance, or where do you draw the line? It's not always that straightforward. We're all sort of somehow doing it, trying to catch it out. And we found out we had a steelwork in Belgium that was owned by a Russian company, but we already blocked off the IPs to Russia and Belarus. So that's how we found out really what the setting was, where the users were sitting. So that's a hot topic.
Yeah, definitely.
Sinead, can I add just one thing over there? I'm just noticing that there's a particular slide in that survey that's about what Canadian companies, the specific challenges they faced about the Ukraine conflict. And so 36% of them, about a third, were facing direct challenges. And the number one concern was about acquiring inputs. So speaking to what Cato was saying earlier about supply chain issues, you think about the auto industry, that's at a global level, but the specific conflict is having direct impacts and contract delays, acquiring inputs, and decreased customer demand. Those were the top three directly implicated business challenges, from the conflict.
Yeah. Do either of you have thoughts on which sectors are forecasted to be the hardest hit by the upcoming recession? No? Oh, can you hear me? Yep.
I guess, sectors that are very exposed to gasoline prices and gas, that's for them to produce the same thing. And when you have to apply 30% increase, because if that is the increase, isn't it, on gasoline? And how is it? How sustainable is it?
Yep.
I think that it isn't our base case that there will be a recession, but if there were to be one, I think the housing industry will definitely take some softening over the next year plus. Plus, I think as people move away from buying goods to getting more into services, even irrespective if there's a recession or not. So those, there's only so many Amazon goods that people are going to buy, and they want to take vacations, they want to do other things. And so those particularly, in the goods exports, we'll probably see a shift to more service-oriented businesses.
Right. Yep. There is a question here. I'm not sure if either of you can answer this one. This is about the CARES Act in the U.S., which printed $6 trillion into the U.S. economy. Can maybe, Ian, can you address about how that relief program will influence our current inflationary times? Any thoughts on that?
To find the question. Here, number 8.
Regarding the CARES Act.
Brian, I think it is. I'm not sure. I know there's been a lot of talk about the extent of U.S. government spending and how much of a role that's played in U.S. inflation. I'm not sure. To be honest, I've seen different studies out there that something like 2/3 of current inflation in the U.S. is related to ongoing supply chains from the pandemic and, I guess, issues related to the war in Ukraine, such as food and energy prices. I'd be guessing if what the other third is, part of it could be from U.S. government spending. But that'll be coming off. I don't think, coming out of the pandemic, most countries, including the U.S., are not going to be ramping up fiscal spending. I mean, if anything, you're going to see reduced budgets over the next while. So I'm not sure how much those relief programs impacted current inflationary. I just don't have a good sense of exactly how that's translated.
Okay. And how about we take one last question here before we wrap up. Let's flipping it around sort of a little bit now, which industries are sort of best positioned to face some of the negative trends that we're seeing? In your opinions? And...
with the great resignation, I think the recruitment industry is doing pretty good at the moment. For sure.
I would probably agree with that. Correct. Yeah.
I think agri-food. I think if you're in the ag sector, there is not enough you could be producing right now. I mean, everybody wants, an agri-food. So, I mean, to me, that has become more apparent with the war in Ukraine. But in general, we were seeing a lot more demand in that sector over the last couple of years.
Okay. Well, we're almost at the top of the hour, so perhaps we'll end there. Gentlemen, I want to thank you very much on behalf of Equifax Canada. And also I'd like to thank our audience today for joining us. Gentlemen, your global perspective is so valuable for our audience, and I appreciate the time that you took to join us and share your insights here today with us. And thank you to everybody who joined us on the webinar. I hope you found today's topic informative and that there were some good insights that you can take away with you. Before you log out, please do take an opportunity to fill out a survey that you will see, and feel free to share any thoughts about today's webinar as well as any recommendations for future events, because we would love to hear from you on that. And for those of you who might have dialed in late or would like to share this session with a friend or colleague, a link to this recording will be sent to everyone in the next 24 hours. If you attended our Consumer Credit Trends presentation last week, you can find that material in this platform under the related content section. Also, I wanted to take a moment to let you know that our next quarterly webinar series will begin in September. So watch the Equifax Canada LinkedIn page for updates on timing for that. And a special thank you to our webinar production team, Stephen, Sandra, Robin, Swarnama, Robert, and the marketing operations team for helping pull this all together. And a special thank you to Jeff Brown, who helped guide me along. It takes a team. So thank you everyone for joining, and please enjoy the rest of your day.
Thank you.